Hello everybody, this is AK. I'm back. So over the weekend I produced quite a few videos. I think like three videos or maybe four if we include Friday. It'll be like 4 videos maybe. And my mind was overly active, more active than usual. And those videos received many comments. And some of the comments have a common thread. And that was, are there any good and cheap stocks right now? And it was linked to the idea that since the SA is going away next year, for those who are above 55, and of course it'll be going away once we turn 55 for those of us who are younger. I'm just a bit younger than 55. Yeah, what to do? Because in the past we could just leave the money parked in the SA, and some would do SA shielding so that there would be more money in the SA to earn risk-free 4% per annum. And that, like I've said before, is not a bad return, right? Risk-free return, right? Since all the money will be shoved into the ordinary account, once the SA is gone and the ordinary account gets paid only 2.5% per annum, only 2.5% per annum. Now we use the word only because in the last couple of years we got used to higher interest rates. But if we recall, for many more years before that, interest rates were much lower than 2.5% per annum, and 2.5% per annum didn't seem that bad, right? So have to be fair, and there could come a time when 2.5% doesn't look that bad again, right? So I think there's really no hurry or no worry, right? Just take our time, right? And when there's opportunity, we deploy the money. Have patience, right? There's no hurry, especially if we are already substantially invested in the stock market. There's no hurry to put more money to work, right? It's not such a bad thing to sit on more cash. Like Charlie Munger said, it takes character to sit on cash. He basically meant that, people who are able to sit on cash are people who have patience to wait for opportunity, right? And then of course we would know by now that Mr. Warren Buffett is sitting on actually his is no longer a cash pile, because when I say it's cash pile, it's a pile of cash. His is more like a mountain of cash. A cash mountain, right? His cash pile or his cash mountain is at an all-time high, more than $200 billion, right? And he's not deploying, he's not buying more stuff, he's selling stuff. In fact, he sold Apple, some of his Apple stocks, and he sold some of his Bank of America stocks, right? And he famously said that, I hold cash not because I like to hold cash, it's because I can't find good investment opportunities at the right price. So something that is worth learning, from Mr. Warren Buffett, and that's patience, and strike when the opportunity knocks, right? So if we really have to put money to work, like I said, some people just don't feel happy, getting 2.5%, and then I really want to put the money to work. Well, if we don't want to wait for opportunity to come along, when yields are much higher, and I'm talking about dividend yields, are much higher. Like for example, during the global financial crisis, I said I could get 12-13% 17-25% kind of yield from REITs, and that was when I went in big on REITs. And of course, during as recently as the pandemic, we could get the banks at below book value, right? So you see, it's not just about yields, it's also whether you can get value from buying below book value, right? There's more than one way to skin a cat, right? Or if you belong to SPCA, please don't flame me. Yeah, there's more than one way to skin a cat. So if we take care of the downside, the upside should take care of itself, right? That means look at what could go wrong, right? And if the downside is well protected or is limited, then the upside will take care of itself, right? So if we want to buy something now to get more than 2.5%, no, we have to understand that the difference might not be very big, right? And that there could be a better time to buy more in future. And if we have that understanding, buying some now probably makes sense. It's probably okay, right? Because we are not going in big. We are not throwing in everything, including the kitchen sink. So I've said the banks, they are good options, but the banks' stock prices have gone up so much, right? And in one of my recent videos over the weekend, I've said that I'm not buying anymore, and I'm being very cautious, right? Because interest rates are going to come down many times over the next 1.5 years. And that's going to have a negative impact on the bank's earnings. No matter how you slice it, there's going to be a negative impact on the bank's earnings, because it's going to be a consistent activity, rate cut until end of 2025. That's the guidance given by the US Fed, right? So it's just like how when interest rates go up very rapidly, REITs find it hard to grapple with, right? It's going up too rapidly and too significantly, right? When you have both speed and depth, or speed and intensity, speed as well as the significant interest rates coupled together going up, the borrowers find it hard to cope, right? When it's the other direction, when it's speedily going down, lenders might find it hard to cope, right? We have to be very realistic about that, and not sugarcoat and just have to accept the truth now. I'm rambling more than usual these days. Anyway, so if we want to buy something now, then maybe you buy something that is not affected by business cycles as much, right? Because banks at the end of the day is cyclical. It's a cyclical business. It's just like property stocks. Those are cyclical businesses, right? Cyclical or cyclical, some people pronounce it as cyclical, but okay, you get my drift, right? So go for something that is not affected by business cycle as much. That would be my bet, right? If we want to put some money to work and don't have to worry about prices going up and down. But there's really no need to worry about prices going up and down if we're investing for income. We are more interested in the value that the business brings to the table. We're not really that interested in the stock prices, especially if we're not going to sell, we're not going to monetize in order to fund our lifestyle, right? We are just interested in whether it's able to and whether it's willing to pay us a consistent dividend, all right? And for that, you want a company with a strong balance sheet. You want a company that has a track record of paying shareholders meaningful dividend. And you want a company that is able to pay you through good and bad times. And I've talked about ComfortDelGro as being one such company. and now it's offering like a 5% dividend yield, right? And it's not really affected by business cycles, right? It's a public transport company. It's not really affected by business cycles. He has a strong balance sheet, sitting on $1 billion in cash, and he has a 5% dividend yield with a 50 to 60% payout ratio. And then if you say, oh, I don't want to be exposed to the taxi segment of the business because I'm afraid of a disruption by private hire, well, you can invest in one of its subsidiaries like SBS Singapore Bus Services. That has a dividend yield of almost 5%, is 4+%, and pays out like half of its earnings as dividends, and I think by now it's debt free. And then of course there's also another subsidiary, Vicom, right? Car inspection company. All of us who have cars know that we have to send our cars for inspection, and now with COE being so expensive, more people will keep their cars longer, beyond 10 years, and beyond 10 years we have to send cars for inspection on a yearly basis. That means more income for Vicom. And Vicom's stock price has come down a lot, right? I think it was like $8 before, and now it's $5 something. Okay, but I'm not thinking straight. I mean, it was like $2 before, now it's like $1 something, $1.30 something per share. I was thinking of $8 and 5 something because that was before the stock split, right? It had a stock split, one stock split into four, right? One share became 4 shares. So when I got in many years ago, it was 5 something per share. So after the stock split, or 1 something per share, then it went up to 2 something per share, and now it's back down to 1 something per share. I think it went up to 2 something per share really because people were looking for yields. Because those were the years when interest rates were very low, and they were just looking for higher yields in companies which can provide higher yields reliably, dividend yields. And Vicom was one of those companies, and it is still one of those companies that can provide a reliable source of dividend. But of course, the yield isn't looking as attractive now, because interest rates are higher now, right? So I mean, the dividend yield is something like 4% per annum, but like I say, it's a rock solid company. So these are a few options which are, CDG, SBS, Vicom. They are probably not affected by business cycles, and we can get 4 to 5% dividend yield, and it's sustainable dividend yield because, like I said, they pay out like between 50 to 60 or 50 to 70% of their earnings as dividends. So if we want to put our money to work, and we don't want to suffer price volatility as much. Something to think about, right? So, sorry for all the rambling. I hope you enjoyed yourself. If AK can talk to himself, so can you. Bye-bye.